So in a previous video, we showed you some comparative balance sheets and comparative income statements. And on that same spreadsheet, down at the bottom, I've set aside an area to do some analysis of these documents. Typically, I title this ratio analysis, but the first thing we're going to study is not a ratio. The first thing we're going to study is a thing called the net working capital. I've got some PowerPoint slides that actually came with a textbook. Let me pop those onto the screen real quick and take a look at the net working capital, NWC. It's current assets minus current liabilities. And the net working capital is just a tool that you use to get an idea of if you have enough money to cover your obligations during the next financial cycle, during the next accounting year. So current assets are going to be turned into cash. Current liabilities are things you have to pay off with cash in the next accounting period. So this is a way of just trying to understand if you've actually got enough cash on hand to meet your obligations, or if you have the ability to get your hands on enough cash to meet your obligations. It's important to remember that when you're running a business, cash is king. Your cash flow is probably the most important thing to remember in household finance, in personal finance, in business finance. Having cash on hand to meet obligations is really important. So what I've done is I've set up this little worksheet area here below my main documents on my spreadsheet so I can show you where I calculate these things. And I've got two columns, one for each of the years, and then I just list the items that are a part of the calculation for whatever it is that I'm looking at. So in order to calculate the net working capital, we take our current assets, and I just use a cell reference. So I found the current assets above me and used an equal sign to enter a cell reference, and I got the current assets. I did the same thing for the current liabilities, and then I just dragged these over like this in order to move over to the next column. And then here I just did a quick subtraction. Type an equal sign to tell Excel you want a formula, and then I clicked on the B42 cell, and then typed a dash to subtract, and then clicked on the B43 cell. I hit enter, and I get my net working capital. What we see here is the net working capital was originally almost $2 million, and then it declined over time. Now that's interesting, and a drop in the net working capital might be interpreted as a bad thing. Now, the number is still positive, so that's going to be a good thing, right? A larger number here means you are in a stronger position, you're more liquid, you're better able to meet the financial demands in the near term of your business, meaning you can pay the bills, right? That's what you want to be able to do, is pay the bills. And the working capital has decreased. Now, maybe that's a good thing, because maybe having $2 million of working capital laying around was a little bit too much. And if you watched the previous video, you know that in 2030, this business was carrying a whole lot of inventory, and in 2031, they trimmed off that inventory. Inventory is, of course, a current asset. So I think personally that getting rid of all that inventory and turning it into cash and doing something more productive with it than having it sit in a freezer, right? Because this is it's a meat company, right? Having it sit in a freezer was probably a good thing. So you have to look at the numbers, look at the overall picture to try to figure out why they changed before you make that call of, is this a good thing or a bad thing? And there are a lot of different liquidity ratios that we could use, and I'm just going to show you a couple of these things. The very first one is a thing called the current ratio. So the current ratio is basically the same thing as your net working capital, only instead of subtracting to get an idea of how much actual money you've got on hand, you're going to divide. You're going to take your current assets and divide by the current liabilities. And what I want to point out here is that a lot of times these financial ratios have names that are very self-explanatory. The current ratio is the current assets divided by the current liabilities. That's pretty straightforward, right? So it's an easy one to remember, not hard to memorize. So again, let's go back to our spreadsheet, and I have this all broken down, and I'm going to start off with a section on my liquidity ratio. So liquidity is a way of understanding our ability to meet our near-term obligations. A business needs to be liquid. Liquidity is a top priority. In fact, there are three things you need to have a successful business from a financial standpoint. The first thing is profit. A business needs to be profitable. The second thing is a business needs to be liquid. It has to have enough cash on hand to operate. And the third thing is it has to be solvent. You got to have these three things. If you're not these three things, it's hard to call the business a success. Of these three things, liquidity is the most important for your most urgent needs. And what do I mean by that? I mean, you can be unprofitable and you can be insolvent, and if you're liquid, you can still live to fight another day. So liquidity is of strategic importance. So the liquidity, the first thing we're going to do is the current ratio. The current ratio is very similar to the net working capital. It's the current assets divided by the current liabilities. There's the formula in the spreadsheet. It's just equals cell B48 / B49, and that gives me a ratio. And what this basically tells us, if that number is bigger than 1, then I have more current assets than liabilities, and that's a good thing. You don't want this number to be less than 1. If this number is less than 1, then your working capital is negative. The second thing is you want this number to be as large as possible, as large as is reasonably possible. It's possible for it to be too large, and you've got to kind of dig into why. For example, if you have a ton of cash just laying around, maybe you should be putting that cash to work instead of just holding on to it as cash. And so if you're just holding cash, you've got to have a reason. So here we basically have $1.43 worth of assets for every dollar in liabilities. Let me rephrase that. We have $1.43 in current assets for every dollar in current liabilities. So we can pay off all of our current liabilities and still have 43 cents left over for every dollar we spent paying off the liabilities. Then that changed and it became 1.07. So it's bigger than 1. So that's going to be good news. But now we only have $1.07 worth of assets for every dollar of liabilities. Let me correct myself. We only have $1.07 of current assets for every current liability. So our cash flow situation, our liquidity, has gotten a lot tighter over time. Let's break this down. Let's check out a couple more. We're going to look at the quick ratio, and we're going to look at the acid test ratio. So the quick ratio is just going to take the current ratio and it's going to back out any inventories. And so this is kind of important because it's really looking at cash and accounts receivable. Do we have enough cash and accounts receivable to cover our current liabilities? And then there's the acid test ratio, which looks just at cash. Do we have enough cash to cover our current liabilities? And as we kind of work our way down through these things, the thing on the top of the fraction is getting smaller each time, which means these ratios are going to get smaller each time, which means we're getting to a more refined way of telling how good we are at being liquid. And by refined, I don't mean like we're getting more accurate or we're getting fancier. I mean, we're getting down to the nitty gritty. Can we survive in this business? Let's take a look at the numbers. All right, so current assets, and I just brought the current assets here, and I just brought the inventories into a space so I can make a calculation, and a current liabilities, and then I just made the calculation here. It's B52 minus B53, which is the current assets minus the inventories, all that divided by the current liabilities. Hit enter, you get a number 0.19. Now this number 0.19 is smaller than the 1.43 we got with the current ratio. It's supposed to be smaller. As you progress through these three liquidity ratios, the numbers get smaller every time. Now, earlier I said that we want our current ratio to definitely be bigger than 1. So if our quick ratio is 1, that's probably a pretty good thing from a standpoint of the strength of the position that we're in. But I'm not going to sit here and say it has to be greater than 1. Because really in this particular case, we're down to asking, do we have enough cash and accounts receivables to cover all of our liabilities? Kind of if we didn't sell anything whatsoever, could we cover our current liabilities? And the answer to that question is absolutely not, because this ratio is less than 1. So this is basically saying that if we just relied on our cash position and our receivables, that we're basically going to come up 81 cents on the dollar short in covering our current liabilities, which means things might be pretty tight if we had to liquidate things quickly. And what I want to point out here is we went from 0.19 to 0.36. So on this measure, we improved, right? Over time, this got better. As we move down the spreadsheet, the numbers are going to have to get smaller. These ratios here, and here are going to have to get smaller, but we see the current ratio didn't improve. The quick ratio improved, right? Moving on to the acid test ratio, which is just the cash divided by the current liabilities, and we get a number of 0.02, basically saying if we were just relying on our cash on hand in our current assets section of our balance sheet, we're going to be 98 cents per dollar short of coming up with the money we need to hit our current liabilities, which is probably not comfortable, but it's not necessarily a bad thing because we would only be doing that in the most dire of circumstances. And what I want to point out is over time, that has improved. We've increased our cash position. We've decreased our liabilities. Do you see that? They were 4.5. Now they're just shy of 4. Cash was 86,000. Now it's $250,000. So we have less current liabilities and more cash. So we're just a little bit more liquid by this measure. And that right there is our liquidity ratios and our net working capital. So we can use all of these things as a tool to see how we're doing as far as staying liquid and becoming more liquid over time. We're going to wrap up the video right here. Thank you so much for watching. Make sure you hit subscribe so you can catch updates to this channel. Thank you much. We'll see you next time.